Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chan. Today we have a very special guest here with me, Hussein Kudrati, who is from HSK Law from Burlington. But before I get to talk to Hussein, I wanted to share with you our Wealth Hacker Conference in the upcoming November. So if you have not already got your ticket, make sure that you visit wealthhacker.ca to find out more about the conference. Last time when we did the conference in 2019, we had over 1,500 people, and Hossein is going to be there with me as well. So that's awesome. And if you have not purchased your ticket, visit wealthhacker.ca. Now, today we're going to talk a little bit about private lending. From a lawyer's perspective, from a legal perspective. So I'm very excited about it because I have a lot of clients who are in the business of lending money out, and I have also a bunch of real estate investors who are in the business of borrowing from a private lender. So I feel that this is the right time to talk about the tips and tricks. Before I get started, let's talk about you first, Hossein. Do you want to introduce yourself?
Sure. So I'm Hussein Kudrati. I've been a lawyer for almost 8 years now. I have a solicitor-based practice focusing on anything real estate, corporate commercial, and estate planning. And I look forward to hopefully adding some value here today.
Awesome. And just so you know, Hossein had done a video on wills before, and he's a lawyer who actually did my will for me. With that, let's get started about private lending. Okay. So a lot of our clients are in the business of lending money out, and they either lend it in their RSP and in their TFSA, and there are so all kind of investment strategies available for these clients to essentially melt down their RSP. Sometimes a lot of our clients even borrow against their line of credit to lend it out in the private lending market. So what are the tips and tricks for them? What are the fine details that they should pay attention to when it comes down to evaluating a deal?
The first thing is to make sure that there's due diligence being done. The first step is to, when you get a lawyer, is to pull the parcel register and to see exactly what is registered on title. Don't trust the commitment and what that's saying, because often there are errors for good reasons, or it could be intentional concealment. The second thing is to make sure that when there's a previous mortgage on title, if you're lending second or third, get an information statement. And if you want to be really, really certain, if you're conservative, and especially if you're borrowing from lines of credit where you are going to be paying interest on your own money, is to try and get a copy of the commitment ahead of you. Because it's not just the interest rate on that first mortgage that matters, it's also the fees that are going to be associated if the borrower is going to default on that first mortgage. So when you're assessing your risk and what your comfort is at loan to value ratio, that key word is LTV. Understand to make sure that your LTV is at a level that you're comfortable lending against. Because if you need to collect and do enforcement proceedings, that LTV will define how successful you're going to be in recovering your funds and then hopefully at least making some money on your investment.
Okay, so let's step back. You're giving a lot of value right here. Yeah. I just want to step back because we're also using a lot of industry language that maybe some of our audience do not understand immediately. Typically, with a private lending deal, at least in my accounting practice with my clients, private lender, typically they're not in first position against a property. When you land it against a property, you typically register, correct me if I'm wrong, register a lien against the property. So let's say the property is worth $1 million and I am a second lender. What it means is that there may be a first mortgagee, which could be the bank, and the bank may have a mortgage on the property for $200,000 mortgage. And now the owner of the property is looking to borrow against the property because there's $800,000 equity in the owner's mind, and come to us and then they say, well, can you lend me $300,000? And now what we do as the private lender, we charge a high interest rate because the risk is higher. And the second, our mortgage is considered a second mortgage, and it is considered ranked after the bank.
Correct.
Yeah. What you were saying earlier was that if the first mortgagee, which let's say assume it's a bank, and the bank has a mortgage of $200,000. The charge on the title, it may be more than $200,000.
Correct. It might be registered for 500, 600. So you might think you have an LTV against 200,000 plus your amount. The loan to value against 200,000 plus whatever 300,000 you want to lend. But if there's a $500,000 registered amount on title, then your extra 300 takes you to 800,000. That LTV might be beyond your risk tolerance. Then you have to factor in that if the borrower defaults on the first charge, then there are going to be additional fees. There's going to be the legal fees. There's going to be any collection fees. There's going to be the power of sale fees. There's always fees associated, whether it's institutional or even if the first lender is a private lender, you have to be even more careful. If it's a private lender, you must ask to see that first commitment, because that's your only way to truly appreciate your risk tolerance.
That's a great point, because I've seen, I mean, from my own personal experience, I'm sure you know a lot more than I do. From my personal experience, I've seen situation where like someone purchased a property, but like with a lender, with a bank, very low interest rate, let's say purchase a property for $1 million and get $800,000 mortgage from the bank. But the bank actually registered a lien against the property for the full $1 million, not $800,000,
Exactly.
right? It's very common practice. So when you think that you are ranked second, it's ranked second to the bank's $1 million charge. And if I were to default on my $800 mortgage with the bank likely charge a bunch of fees, lawyer fee, legal fees, and then discharge fees that you mentioned. Exactly. And then that may make up that $200,000 difference, and there may be nothing left on for the second private mortgage lender.
And the other thing you may want to do, now banks typically will not give consent to a second mortgage going behind them.
Right.
But you always try and ask for it, especially if it's a private lender, you want the consent. If you're going to be going second without the consent, negotiate yourself a fee upfront as part of your thing to account for the added risk, because you're not getting that consent, so that you won't know the true story of what the first mortgage is, at least completely. So you're getting some money that you're putting in right back off the table, and you're making money off the bat the day you're funding. So that's something that's to think about, and we call that the interest reserve.
Ah, cool.
Yeah.
Now, so these are all like great tips in terms of lending money out on a particular property. But what about there are private lending that like I've heard in the marketplace that would give you a yield of like 13%, 15%, sometimes 20%. And they're on the higher risk side. They are more like on a promissory note basis. What should the investor be looking at, and what should they pay attention to when they draft up or commit themselves to a promissory note type of arrangement?
So a promissory note type of arrangement is extremely risky because you don't have a lot of security on the property. What some people do, and again, talk to your own lawyers about this, is that they would ask that if you default on a payment, they can register that security. So you pre-sign a lot of documents that essentially you're irrevocably directing in the event of a default, and the appropriate notice and appropriate terms have been followed, that you allow for the lender to then register on title in that event. Because otherwise, as a lender, if you don't have something to give you security at the end of the day, it's not great. And again, what you do is you have a higher lender fee when you're going to be doing an unsecured loan, because you want to try and get as much of your money back as soon as possible.
That's a great tip. You can pre-sign all these arrangements and get a consent ahead of time. Yeah. Typically, people do promissory note arrangement. The borrower are usually using the promissory note for whatever reason using the loan. A lot of them are using it for flipping purpose or construction purpose. So that's the reason why they can afford to pay higher interest rate. But then the risk is also much higher.
Absolutely, especially when you see like the market shifting. And like people have built their pro formas and how they go to achieve what their targets are. But then when the market shifts and their sale price isn't hitting what they thought they would, they may not have the money to pay you back. So the more you can take off the table up front, the better off position you will be in. And remember, if you control the money, you get to make the rules.
That's a great point. Yeah. Now that we cover all the points that we need to pay attention to as the private lender, what about the borrower? Because a lot of real estate investors are using private lending to at least fund their deal, and they do their BRRRR strategy like buy, renovate, refinance, and I don't know, rent. I think that those are the term for strategy. So how do you protect yourself? Because I've heard stories, horrible stories about people using this strategy, using private money, and then they eventually have to liquidate all their properties because they can't pay.
So the first thing is to be disciplined and understand how much risk you can take. Like almost stress test yourself, like the way you must have heard the term, the bank stress test to see if you can qualify. Stress test yourself to see what you can take on. The second thing is especially with the burst strategies, your numbers are going to be absolutely critical because small difference of 1,000 here, a couple of thousand there can make a difference about whether you can actually burr out. So what you do is understand what you're truly paying. If you're not familiar and you're not seasoned at reviewing private lender commitments, talk to your accountant, talk to your lawyer, ideally talk to both to understand both the tax implications of how everything is going to play out and the legal implications of what you're actually being asked to give. What security are you being asked to provide? Is it acceptable? Because if there's talk about like cross collateral over multiple properties, that might not be desirable based on where you're at in different projects. Then also make sure that you understand what you're actually paying. We talked about the benefit of other fees for the lender. You have to think about the cost of that from your perspective as the borrower. There are examples that Sherry and I have discussed where interest rates can be like 8.99%. But by the time you add in the fees, the legal fees, because remember, as a private borrower, you pay the lender's legal fees. Make sure the commitment caps what your responsibility is. Then if the lender's lawyer chooses to charge more, make that the lender's prerogative. And find a number that you can both live with. At least that way, when you're running through your numbers for your burr plan, you know that, okay, if I hit these targets, I make money. Because the worst thing is you go through the burr, you put in the effort, and you don't make any money. Or even worse, you start having power of sale proceedings and things like that against you. Because the moment, remember, litigation searches show, and the moment you've defaulted one, and this is like your full-time gig, you essentially killed the career you had planned for yourself. So be very careful.
So let's get back to that example that we discussed earlier. So you had a client who borrowed from
a private, like sort of like an institutional, but it was a private lender, like a larger, like MIC almost, if you will. Borrowed at 8.99%. He expected legal fees. He was quoted by his mortgage broker that legal fees would be about $2,500 to $3,000. Ended up getting legal fees of close to $7,500. Then he went in and he thought he was paying 2%, one for broker, one for lender fee, but it turned out to be 2% for lender fee, 1% for broker fee. And again, he had another extra point to add to his calculations. And then there were some other fees added in there, interest adjustment, all these other things that he had to factor in. And he ended up costing him it brought his borrowing from 8.99 to just under 13%. And the reality is the client comes to me and says, if I knew I had to pay that percentage, I would not have done it because I had cheaper sources of money offered to me if he had looked at it. So the key is don't rush in desperation to sign a deal. If you don't know, do your best to buy yourself time and seek advice. Seek advice from people who are seasoned, who have done this before and know what they're looking for. Because honestly, someone who's done it knows exactly where to look in the commitment for specific details that will make your life easier.
Yes, so if you don't have a professional on your team to look through these documents for you, make sure that you go to Hussein. I have a personal story to share, not personal, but from what I've seen in my clientele. I have a client who went to a private lender because they don't qualify for mortgages. So they went to a mortgage broker and they were able to secure a private lender. And I did the taxes and I looked at the number. I was like, I can't believe how much you pay. So they arranged a mortgage for maybe roughly about $200,000, $300,000. I don't remember the exact number. And then it's being renewed every single year. So the year that we did it, it was a renewal. And it cost them $20,000 to renew. Because there is also a renewal fee when you renew a private mortgage. And the broker who initially set up the deal would charge another 1% or 2%, whatever percentage it is. And it ended up every single year when she renewed, it cost her another $20,000 on a $200,000 loan. That's crazy.
It is.
Yeah, and then the year after, she switched from the private lender to sort of not an A lender, but like a B lender. And because she ended the private mortgage early, she is required to pay the full year of mortgage interest on the private lending deal. And then she's also required to pay another fee to the mortgage broker.
She should speak to a lawyer because some of that seems like it's not legal.
Yeah?
Yeah, some of
Think
that's
so?
not legal.
Like, she's shocked to find out how much she's paying. Because, you know, like at the end of the day, when you do refinancing, you get a number from your lawyer and from the statement of adjustments. They just don't know what they're getting. They thought that they're refinancing to get out of a bad 9%, 12% deal. And so whatever left over is in their hand, and that's all they care about. So yeah, I think it is important for them to speak to a qualified professional.
100%.
Yeah. Okay, so now that we talked about the private lending on the lender side, from the lender side, and the private lending from the borrower side, I know that the interest rate has been going up, and the rumor as of the recording of today is that there will be another interest rate hike because there is an 8.8% of inflation. So I have some clients who may or may not be able to survive this interest rate hike. They have a property, it's vacant, they need to put in a lot of money in terms of renovation to bring it up to standard for people to live in. And they are saying that they may or may not be able to make the mortgage payment. So if you are in one of the situations that you would not be able to make a payment on your mortgage, what are your obligations and what is the best advice that you can give these people?
So ultimately, your obligations are you've signed a contract to make your payments. However, depending on who your lender is, lenders are also business people, right? They understand the changing market, it's trap people, whatever. Talk to your lender. Option one is if you talk to them, they might be willing to work with you. Like I know some banks do mortgage pauses, mortgage holidays, things like that. For a short term, they may be willing to work with you, and then they'll just increase your payments further down when conditions have changed and improved. Two, be disciplined and honest with yourself. Ultimately, if you cannot afford to have this arrangement, sell the property. I know it sucks to say this, especially if you know what your property was worth in like February of this year to now. It's hard. But the reality is if you're struggling with payments and you don't know what the market is, no one has a crystal ball, it might be worth selling and negotiating already with the bank saying, hey, we can't pay you back everything. What are you willing to do? Because instead of going through the power of sale proceedings and everything else, or going through bankruptcy at worst case, at least try and work out a solution to keep your solvency, to allow you to get back into the game as quickly as possible. Ego has to be set aside, and you have to make the decision and look at the cold numbers. And again, like talk to Cherry, let her go through your numbers. Her team will tell you, is this salvageable or not? Don't drag it out, because in the end, you'll just dig yourself deeper and deeper and make some of the solutions disappear before you've even had the chance to explore them.
Yeah, we once worked with someone who were behind in terms of mortgage payment to the point that they refused to look at any of the bank letters. They hide behind the scene and they were not able to meet the obligation. There were multiple letters to essentially warning letter that saying that the bank would go after the property. And to the point that finally we decided, hey, let's sell it off and make the arrangement. I think we were really close to the foreclosure day, but we were able to talk to the bank and the bank would let the sale go through. And it helps a lot. I don't know how much, at the end of the day, I don't know how much that person pay in terms of the bank fees, because at that point, the fees are piling up. The bank, based on all the stuff that you sign at closing, they have the right to charge as much fees as they want, essentially. You want to be able to avoid that situation and make sure that you communicate upfront, and that's going to help big time. Now, I have one final question for you, okay?
Yes.
I know we didn't prep you for this, but how do people contact you?
They can contact me by calling the firm at 289-266-0553 or emailing the firm at hkudrati, Kudrati, at hsklawfirm.ca. At my firm, you will get to speak to me directly, and that's one of the beauties. You get to speak to the lawyer when you want to.
Yes, I know Hussein is super responsive, at least to my request.
Yeah.
I know he's also super responsive to all of our clients' requests. So if you have any legal matter, or if you are in the business of doing private lending and you want someone to review your contract, make sure that you give Hossein a call. Now, thank you so much for coming on.
Thank you for having me. It's really good to see you again.
Yeah. And if you liked our video, make sure you give us a thumbs up and hit the subscribe button below. Until next time, thanks for watching.
Awesome.
Awesome.